Good evening all, and welcome to tonight's introductory webinar. My name is Jake Sewell and I'm your branch manager here at the Property Club, and also mentor to a few of you as well, so welcome along tonight. So look, it's just a basic workshop. A few of you might have been to some of them before, but I've added a few extra bits and pieces there. So, and if you've got any questions along the way, please enter them in your chat box there, because we will do a few questions at the end of tonight's workshop. So feel free to ask those questions later on. So there's a little fast fact for you there, or a couple of facts there for you. So earning $87,000, you'd be paying $250 you pay to the tax man. So I'm sure a few of you out there at the moment, especially compiling your tax. Those of you who don't have properties, you're probably feeling that pain at the moment. So yeah, a bit of a scary one there. So you're getting up and working the first 2 days of the week. So like today, and you're earning it for someone else. So not ideal if you don't have properties. And there's a little one there for you as well. So 50% of revenue earned by us investors goes to the state and local government. So property investing. We hear those things, well, you're a bad person, you don't pay tax, but when you break it all down, we're keeping the economy afloat, that's for sure. Just bear with me, my computer's having a bit of a moment at the minute. There we go. So look, our basic disclaimer, this isn't advice, this is just general information. So I'll let you read that, but if you want further professional advice, please seek that independently. So look, there's for those of you who don't know, that's myself, Jake, and my wife Nikki. That was about I can tell you almost exactly about 9 months ago, that photo. So that obviously we've had a little son since then, and then you can see around us there's what our sort of property portfolio is looking like at the moment. So I guess why are we doing this? So for us, and the reason I got into it is I wanted to have options. I don't want to be working the rest of my life, so I wanted to be able to have some lifestyle options, and I'm sure we all do as well. So there's some of my favourite things there. So a bit of a keen golfer, so I'd love to get over to the Masters there one day, and a few other things there, like I'd love to go to every F1 race. You can see that one there, nighttime race. That'd be one I'd love to get over to in Singapore, and spoiling grandkids and all that sort of nice stuff we want to be able to do. So that's why we do property investing. So how much money are you going to need at the end of the day? That's what it's all about. So there's our average life expectancy. Male's 81, female's 85. So one of my mentors, Fred, he's got an awful sense of humour, but he believes that, because the men look after the women so well, that's why they live longer than we do. So I'll let you guys be the judge of that one. But and that's growing, so modern medicines and treatment and hospitals and all that number keeps increasing. So that's at today's numbers, but as we get older, that number will definitely increase. So here's look, it's a little calculator you can find online. It's just a retirement standard calculator, but it's a good one to have a look at. When we finish this webinar, I'll send you all the link to it. But that's the basic table there. So you can see there, now this is run on a comfortable lifestyle. So there's a couple of assumptions that they make in that. One being that you own your own household outright, and you're of good health, and you're not going to need medical procedures and all that sort of stuff. So in the assumptions on that website, you can have a look, but it says, and it's not a lavish lifestyle by any means, but you might be able to do the odd kitchen renovation and go out for the odd dinner and things like that. So you can see there, 60,000 is the number they're assuming, and that's just for a comfortable lifestyle. So based on those numbers, if we want to stop working at the age of 60 and we're just going to live to 80, which, like I said, that's just an average, using that 60,000 figure, you're going to need about $1.2 million. And now that's in today's money, so factoring CPI and all those sorts of things, that figure's going to get pushed out. If we're wanting to retire earlier than that at say 55, 1.5 million. So not many of us are going to have 1.5 million in super or saved up, that's for sure. So we need to look at other options. And we can see there, so this report from late last year, only 1% of the population are wealthy. So we want to be in that 5% anyway. Comforters are financially secure. Certainly don't want to still be working. I know we're an ageing population. Potentially most of us will be. The 15 number there, I don't think that's a great option. It's a fact, but it's not a great one. So, and 73% of us depended on welfare. So I certainly know that I didn't want to be one of those 73, and that's why I've engaged in purchasing a portfolio of properties. So a couple of sad facts here as well. So that's the current age pension, and so that 60,000 figure we looked at, for a couple of 34,000, that's not even that's only just half of that. So not much of a life at all, to be fair. And the asset test for that is changing all the time. So they recently changed it, and that locked out a lot of people from receiving a pension or a part pension even. So that's something we don't really want to rely on, is the age pension. And then the other obvious one is superannuation. So always, this picture you can see with the ad there, I always have a bit of a chuckle when I see that one, and they're talking about if you're clever and you put your super into Interest Super Fund, then you'd have so much more. Over a 10-year span, I think it's like 30 grand. So in 10 years, 30 grand, that's not even half a year. So I always have a bit of a chuckle when I see that ad. You can see there the numbers up there. So now that's just the median super balance as well. So the actual average is a lot less than that. So that's the median. So there's some wealthier people out there with a higher balance. But if you look at it, the actual average, a lot less than that. So 292, that gives you 5 years worth combined with the female. So 7 years. So it's not really going to cut it, is it? And the super laws are always changing, so it keeps getting pushed out. We know they're wanting to make that new age 70 within the next 5 or 6 years, and who knows what that figure will get pushed out to and what limitations they'll keep placing on super. So you can see there the pension and super, not a great option. So what's the best option? Well, for me and many of my members, it's to invest in residential investment property. So why property? Why not shares? Why not super and things like that? There's a couple of things. So high leverage. So that means we can borrow a large portion of the asset. Shares and things like that. Potentially the bank might lend you 50 up to 60%. Whereas with property, look, we're still able to get 90%. You were able to borrow 90, potentially even 95% of the assets. So we're not having to use as much of our own capital. So that shows you that the banks see it as less of a risk to lend you that higher portion of money. So it's a good indicator that it's a low risk strategy. Long-term capital growth, so that's where the real wealth in property comes from. I know many of you have probably heard of positive cash flow properties, but the Property Club here, over our 24 years, we've established a low risk buy and long-term growth holding strategy. And that's where the real money is. So it's not from rental income so much. The rent's there is great to offset the mortgage, but it's more about the growing value of that asset that we're after. And like you said, there minimum no cash needed. So that that refers back to that high leverage. So many of us have our own homes. We've got equity in that property. Why not use that ability there to be able to go and buy some more properties? And like I said, they're rental income, so that's going to help offset the mortgage repayments. You've then got your tax savings, sort of balancing that out. And nowadays with interest rates the way they are on the increase a little bit, but you can hold an asset worth 500 grand for next to nothing after tax. So it's a very good way of doing it. And look, all investing has a risk, but property is a lower risk, provided you save it for the long term and do it correctly. It's a bit of a retro slide, this one. Must have got this one off one of my older mentors, potentially. But it's a valid one. What do you think your parents paid for their home? What is it worth now? So I can, even myself, so we grew up on a farm. But I remember them telling me, they bought the property maybe for 60 or 70 grand, and I had a look up the other day. Obviously, they sold it years ago, but it'd be worth well over 600,000 now. And that wasn't in so much a desirable place either. So that's the power of property. And I sort of touched on this earlier that property investors are actually underpinning the wealth and that of Australia. So there's another little fact I read the other day too. 50% of state and local government revenue comes from property taxes. So when we hear people say, "Oh, you're reducing your tax," you got to be helping Australians. We're more than truly doing that. That's for sure. And here's just another little fact I read to put it into context. So each year, I hate reading slides, but each year property investors pay $8 billion in stamp duty, $7 billion in land tax, and $130 in council taxes. So on top of that, you've got the net rental gains of $7.5 billion. So that's a huge amount of money. And to put it into context there, like I've put underneath there, Brisbane's, we're long-awaited Cross River Rail. So I live in Queensland, and I've been hearing about this for years. But that's the budget for that is $7 billion. So that's only 1 year's worth of land tax would cover that. So it really shows you and puts in perspective how much tax we are actually paying and how powerful it is. Little slide there. I just thought I'd break it up there. So you saw the photo at the start there with my pregnant wife, Nikki. So that's the crying result of it. Normally he's pretty good. He's just turned 8 months old, and my wife has this thing with these little milestone. I think they're called milestone cards. That was the best photo she got. So it wasn't a good day on his 8-month birthday. So poor little Aston. So he's got his teeth coming through. We found his top one coming through this morning. So he's going through the drooly, sooky phase, but he's a very good kid, that's for sure. Just thought I'd put it in there for a bit of fun. So I guess why does it grow in value? Okay, so it's all well and good just to say that it will grow in value, but what's underpinning that? Well, a large part of that is our ever increasing population. So we're currently at 24.6 million. I got that off the ABS today. I think it's something like every 1 minute and 23 seconds it grows by one, or whatever it is. So I grabbed that number off today, but that's ever increasing. We're seeing migration from other countries, and that doesn't look like slowing down at any point in time. Another, a bit of a sad one, but it's a reality, is the amount of separations that are happening now. So it's above 50%. I think it's about 53, 54%, and that just seems to be growing as well. It's a bit of a modern thing these days. So that means we're going to need more households. So instead of housing for a family, potentially you're going to need an extra dwelling for that person too. So that's just part of life. And look, there is less house being built. There's less housing being built, and particularly right at this moment, you'll hear through the media. Media is a necessary evil, but it's always quite negative. You wouldn't go on and watch the news if you want to make yourself feel good, that's for sure. But you always hear about the oversupply and this and that. A couple of facts I've read recently is the amount of dwellings that have been approved that the building construction has then lapsed. So something like 383 dwellings within 10 kilometres of the Brisbane CBD, I believe it was. The building, it's been in council, it's got its approvals in place, and then for one reason or another, mostly due to finance and the vendors not being able to get it, they're not being built. So there may be pockets where there's a lot going up, but there's nothing in the background being built behind it. So by the time that supply's soaked up, we're going to be well short of property. So it's the whole supply and demand thing there. I won't go into Kevin Young's banana story. I'm hoping you've all heard that, or hoping you haven't heard that, but I won't go into that one. But it's the basic laws of supply and demand. And housing goes up as income increases. It's pretty basic stuff, but with CPI and things like that, so the rent increases and the property prices increase. So there's been talk about our wages not growing significantly like or to the rate they used to in the past. That's for sure. But we're sort of in a phase of low interest rates and low inflation at the moment, so a little bit different to those days of high inflation, but it's all relative. And there's an interesting picture. I'll let you soak that one in, but we spoke on that last slide a little bit about migration from overseas. That's a hugely populated area, and where's their closest place they're going to get to? They're massive on education and things like that there. So there's a huge amount of those people who their next place they're looking at a lifestyle is over here in Australia. That's a really interesting slide, that one. And look, it's a bit of a messy slide, that one, but you can see there that runs over 33 years, that slide. So trends in prices. You can see the ebbs and flows. It's not a straight line, but prices just go up over time. That's just what happens. So you can see the top line there, the Sydney one, it has its peaks, it has its troughs, it levels out for a while. But in the grand scheme of things in the long term, all markets are moving up. So you can see there that the five main markets which we promote in the club there, Melbourne, Darwin, Brisbane, Sydney and Perth. Yeah, it's not a straight line, but you can see over the long term, despite all those events, those world events that you can see there underneath, and some just national events, that the property prices keep increasing. So we spoke before about leverage. What is leverage and what can it do for us? So here's just a little example here, and is a couple of not so good options. Now we're going to look at the property option. So let's assume we've got $45,000 in savings. So potentially that's cash. That might be some equity sitting in your property. But let's see what we can do with that 45 grand. So you can see there in column one, we might put that in a term deposit. By the time you've earned your interest and then paid taxes on those interests, I mean, it's not really working for you. So I'll put a question mark next to those 45,000s, but it's going to be very small, if anything. Car or boat, so look, we all need one of those, but it's not an appreciating asset, that's for sure. So, and we can all relate to that. So we've probably all bought cars or new cars before, and it's a necessity, but it's not an investment, that's for sure. So year one, 45,000. We know that as soon as we drive it out of the lot, it's probably going to lose 10,000. But even if we keep it in good repair, you can see it drop off there. So not a good use of funds. And super, yes, it will double, providing you're contributing to that and things like that. But that's the amount of super you need to contribute on top of your employee contributions, and now that's getting capped too. I'm sure you've all read that. They've limited the amount of concessional contributions you can make, and they're just shifting the goalpost. So, super for me is not that great. So let's have a look at the options. So let's use that 45, and let's go down the property. Let's go down the property option here. So 45, like I said before, cash or equity in your property. OPM, so that stands for other people's money. So I guess that's the bank, that's the lender. So they're going to lend you, 90% value of that asset. So that means we can get a $450,000 property. Now, it doesn't have purchasing costs like stamp duty and a few things like that built in, but it gives you a sort of good idea still. So with that 45,000, we've now gone out and bought a property for 450,000. So 10 years down the track, now just to make it simple, we're using the property doubling in 10 years. Look, historically it has been between 7 and 10 years. During this period in time, like I said, low inflation, low interest rates, potentially that's going to take longer. But we're just assuming 10 years here. So even if you wanted to be super pessimistic and made it 20, the numbers are still going to look very good. But let's just base it around 10 years. So you're only paying the interest component of that loan, so you can see your debt has remained the same, but your asset has increased significantly. So that's $405,000 of other people's money. The asset's now doubled. So your net equity, $495,000. So it's looking a little bit better than the car or the boat you just bought, and even your super. And then again, so like I said, property doesn't go in a straight line, but assuming all things are equal and it's doubling in 10 years, that property is now worth 1.8. The debt has remained level because you're just paying the interest component. So you're now left with your equity of 1.4 million. Pretty powerful stuff. So you can, that's just with one property. We talk about building a portfolio of properties, 3 or 4 properties. So you've got 3 or 4 properties doing this for you. All of a sudden, things are looking pretty good. This is what I spoke about. That property isn't a get-rich-quick scheme. It takes time. It's a long-term strategy. If you want to get rich quickly, I suggest you go to the casino or dabble in the share market, but that's where the professionals win the money and most of us lose out. So time in the market is key. So as we look here, I'll circle one key component here that comes up for me. There we go. So look at that. So if you've held that property, and this is nationally, so this is every property. So this isn't just your Sydney and Melbourne. This is every single property. So those mining towns, and I shouldn't say Gladstone, but places like that where they've taken a huge hit, those rural areas, encompasses every property Australia-wide. So if you've held on to that property for 15 years or more, 95% of the time you're doubling your money. So it says 100% or more profit. So 95% of the time, if you've held on to that asset for more than 15 years, you're doubling your money. And that's what you're trying to achieve here anyway. You shouldn't be trying to buy a property for 3 or 4 years and hoping you're going to make 200,000. You're in there for the long haul. And that's what we're here to do at the Property Club, is help keep you motivated and keep your eye on the prize there. So that's what we're all in it for, that long-term game and long-term growth. And here's a big key with what we've learned here at the Property Club. So it really is important to diversify where you're buying your portfolio. So if you were to buy, let's just say you bought 4 properties, all in Queensland, 8 years ago. We all know Queensland, for those of you who live in Queensland hasn't had much growth at all. Okay, so if you bought those 4 properties, they probably haven't grown much and you're just sitting where you were and you haven't really achieved much. But that's why we diversify. Markets move at different rates. So you've got your Sydney market, Melbourne, Perth and Darwin. They all move at different rates. So if you had a property, and like myself in Sydney, you'd be cheering because that market's done fantastic things. So at the same time you've held your Brisbane property, your Sydney property's been holding that one up, and vice versa. So you need to spread your risk. It's the same with any investment, but spread your risk. So diversify where you buy, diversify what you buy, so the property type, and diversify your banks as well. So it's all about diversification, but I can't stress that enough. Most people are comfortable buying in their own backyard, and we call them postcode buyers, but that's where you come unstuck. So you really need to, and this is what we're here at the Property Club to help you with your mentor. We're identifying these areas. Okay, so big one there. Make sure you don't forget that. And look, here's a basic look at our game plan. So the idea is to get these loans like we looked at before for the $450,000, and just pay the interest component. Now, and the red there, that highlights the gain and the value. So again, it's not a straight line, but for this purpose, we've made it like that. But basically, keeping the debt constant, and while that asset is growing in value, so you're never actually paying down that debt, but the asset is growing, and the bank's providing your LVR, which is your loan to value ratio, provided that's at a healthy level, generally below 80%. They're happy for you to pay the interest component most of the time. Now, there's been a bit going on in the finance world lately, and obviously because I do this full time, I'm across it all, and that is that the banks have been cracking down a fair bit on interest-only lending, and they're really trying to push people back into the principal and interest mindset. Now, at the end of the day, what we're talking about creating this growth here and holding it for the long term. And creating it for the long term, as you can see in there, the graph, it means your loan to value ratio is decreasing. So if we're having to pay some of the principal, it's not the end of the world. We're decreasing our debt anyway, which is a good thing. And generally speaking, the banks will lend you more if you're paying some of the principal a lot easier as well. And we're seeing that at the moment though, in regards to interest rates. So potentially, an interest rate before where it was at, say 4% for an interest only, they're now loading that up, maybe up to a 5. But they're in return rewarding those paying principal and interest, and they'll be getting, sub 4. So a big difference there. So I'm going to show a video actually from one of our club brokers who spoke at our conference recently about this, like the changing in lending environment. And he talks about the principal and interest repayment versus the interest only and what that actually means. So I'm going to bring up his video here, and we're just going to have a quick watch of this. So his name's Rail Bricker from House and Home Loans, and he's one of his brokers, Harinder. A lot of you would know him. He works from head office here. He was our broker of the year for the property club last year. So this is a Rail Bricker anyway. So let's listen to what he has to say. Sorry about that. It cut out there. Not sure what happened there. Let's give it ahead. Okay, so that talks about the whole principal and interest thing very quickly. Like I said, the philosophy of the club has always been to just pay that interest component of the loan because that's the part that's tax deductible, and paying the principal component is not. But you can see there when you're comparing the interest rate loading they're putting on investment properties, potentially it's not a bad idea reducing some of that debt down on your investment property as well. So look, I'm not giving advice on any of this. This is just my personal take on it. Obviously, you should consult your accountant and broker and things like that. But look, that's sort of where things are at in the finance world a little bit, and I just thought I'd touch on that a little bit. So look, why property club? What's so good about us? Well, I guess for me, I joined about 6 years ago. For me, it was I had my own mentors, so my own experienced mentors. So they were an investor themselves. So they're not salespeople. So it's like me. I'm not a registered sales license. I'm not a real estate agent. All I am is just an investor. You can tell probably by my presentation, I'm not a professional speaker. I'm just, just here discussing what I've done, what I've help my members do and things like that. So, your own person who's been there, done that, going through it with you together is worth its weight in gold, I tell you. And 5,500 property millionaires. So they're people who have purchased property through the club with a portfolio of over $1 million. Pretty impressive stuff, So we've helped a lot of people, and there's a lot of experience within the property club there. 80,000 members, so that's a massive database, a huge amount of people. And when we go to the vendors, or the researchers go to our vendors to negotiate prices, and we've got that kind of power in numbers, big thing in helping us get the best incentives and prices for our members. And so huge bargaining power with whatever we do. And 24 years, so there's not many property investment groups that have been going out doing this for that long. So we've helped a lot of people. We've done, a fantastic job, and we continue to do so. So there's a lot of these, there's a lot of property groups out there that are sort of based on the same principles as us. They last 2 or 3 years, you don't hear from them again. So 24 years, you've got that ongoing support. You know where we are. There's a lot to like about that. I'm just going to run on a couple of the real benefits as well that sort of drew me to the club. One is, our property researchers. So we've got something like 35 property researchers Australia-wide. All they do is source the best residential investment property for our members. So that's their job. They're all investors themselves. They know exactly what they're looking for, and they're out there dealing directly with the vendors, the developers, so you don't have to do it. I recently went through the process of buying my own house, had to talk to a real estate agent. Nightmare, hated it. And I, do this sort of stuff day in, day out, but having to deal with a real estate agent, it's no surprise that people buy one investment property and that's it, because it's too hard, because it's just a nightmare. So they're out there purely finding the best stock for you. So, and they know what they're looking for, because they're investors themselves. They're looking for, where's the population moving, what local resources and infrastructure is around there, what sort of transport, what's going to draw those potential tenants to your property, and where's that long-term growth area going to be, hopefully. So, they're out there working for you, finding us the best properties, and, that's worth its weight in gold. Trying to do all the research yourself, horrible, nightmare. Takes forever, especially trying to buy interstate and all that sort of stuff. When we put a profile on our member link, so once you've done your wealth check, you can have access to our stock list. There's something like 90 pages per property of information on some of them, which is, it's too much if you ask me. You go to an agent, you get a one-page flyer. This has got everything, rental appraisals, proximity to schools, recent sales in the area, floor plans, just everything. So a lot of information there for you, but it'd take you forever to try and do that on your own. And another really strong benefit is, because I deal with this daily, is the multi-listing. So that's one fear of people, is what if I don't have a tenant, or what happens when the tenant moves out, I can't get a new one. We've got this really unique system here at the Property Club. It's actually quite big in America, and I believe Kevin Young, who's a founder, he got the idea from America. But what it is, we have a lockbox on site. So let's just say, you've had the property for 4 years, had the same tenant, everything's been fantastic. They've now given you notice they're not going to renew. The current agent's gone, look, I haven't got any interest at the moment. I don't know where your next tenant's going to come from. What we can then do at the end of that lease is we take the keys, we put them in, it's called a lockbox. So you put it on site, and our best say 5 or 6 property managers in that area receive the code for that lockbox. They go, take their professional photos, advertise it, do their openings, offer free iPads or whatever they need to do to secure that business on your behalf. So they're very hungry to get you that business. And then what happens through the multi-listing is the applications come through us. We then send them out to you, go, Mary and John, which one would you like to select? Okay, we'll approve application 2. All right, that was LJ Hooker. So LJ Hooker is now your agent, managing agent for the next 12 months. And that is an ongoing thing for free for the life you have that property. It's an amazing thing, and it definitely keeps our vacancy rates well below industry standard by doing that. You'll be surprised that even having the ability to be able to multi-list a property will, the current agent you've got will be aware that they could lose that management, so they'll do everything they can to secure a tenant. Property management is a massive business nowadays, and just having one property on their books is worth around about $4,000-$5,000. So it's huge business for them. So it's in their best interest to keep yours tenanted as well. So look, they're just a couple of the benefits. There's many more, but they're sort of the two that really drew me to the property club, and continue to help our members every day. So look, I guess before you can do anything further, really, you need to find out where your finances are at. So if you haven't done we call it a financial wealth check form. Basically all it is, you put your details in there, it goes to one of our club approved brokers, and they just give you not only an idea of what you can borrow, but how you could potentially borrow more, and what you could do to, save on current loans you may have. Just recently, so, like I said, I do this day in, day out. I had the broker have a look at my stuff. One bit of paper later, he was able to save me $360 just by signing my name once. He was able to sharpen up my interest rate, something like 0.6%. So it's amazing, that having a review of your finances, and you should do this every 6 months, really. I hadn't done it for a little while, and just thought I'll have him have a look, and there you go. I know one of my mentors saved about 18 grand a year this year by having his loans reviewed. So, like I said, unless you do the form, you'll never know. So important to get one done. If you haven't done one for the last 6 months, make sure you do one of those. So after this webinar, I'll send you a copy, fill it out and get it back to us. So our next big event, well, look, we've got these little workshops and webinars, but our next main event is the Queensland Property Extravaganza. Okay, so we're having it at the Stanford Hotel in Brisbane. Fantastic venue. I was out there a couple of weeks ago having a look. And look, we're going to have Kevin Young, who's the founder of the club. He's going to be presenting. He's going to get his crystal ball out and tell us what the horizon looks like, and where to invest. He's got a big thing on. He's got this suspicion that they're going to change regulations in the budget next year, so we should really be buying up while we can now. Clifford Bennett, so he's a world-renowned economist. He's been forecast as one of the most, he's been labelled one of the most accurate forecasters. So he's always worth his weight in gold listening to. I'll be doing a little bit of a talk there if they've got time for me. But we're going to be getting a couple of developers from interstate, and I've told them to bring your best deals and put them on the table, and let's see how we go. So I've put it out to tender to about a dozen of them. We'll have 3 of them there, and we'll see what kind of deals they can rustle up for us for the day. So look, that's going to be a fantastic event. I'll send you some info on that one. It's a free event. We're also doing like a teppanyaki dinner afterwards, which is going to be lots of fun. So that will have a cost involved, but that's you get to rub shoulders with Kevin and Clifford and myself and a few others. So you'd have to be quick to book that one, but that's going to be a lot of fun. So please come along to that day. It's going to be really, really good. So questions. There's a few of you out there. So if you've got it, I'll just check my chat box to see if I've had any come through since we've been on. And if you've got any now, type away. I can see one here that says about the health up. So it just says here, is the wealth check a hit on my credit file? No, it's not. It's not a hit on your credit file in any way. All it does is just it's a conversation starter with one of our brokers. So once they get the form, they'll give you a call or an email, discuss a few things, and go from there. So by no means is it a hit on your credit file. I've got one more question there that's come through. It says, what am I doing? What am I? So I guess that's me. What am I currently doing with my loans? Okay. So we mentioned the whole principal and interest versus interest thing, fixed versus variable, all that sort of stuff. So look, I've got about 9 or 10 loans in total, and I've really got a bit of a mixture. So I'm pretty happy with myself. I fixed a couple when they're in the 3s. That was probably back in September, October last year. And they're interest-only loans. I do have a couple that are principal and interest as well, so I've let them roll over to principal and interest, and I'm getting a better rate for that. So I've really mixed up what I've done there, but you've really got to keep on top of your interest rates nowadays and see what the best product out there is. I'm just settling on another property in Darwin at the moment, and I actually got that approved for an interest-only loan. But since getting the approval, this particular lender has then come out saying, look, we're going to raise interest rates 0.3, so I'm now actually going to look at, even though I've got it approved at interest-only, I'd probably go on to principal and interest because I can get a much sharper rate there, and the repayments aren't going to be much more. So, you really got to assess each property and each loan for where it's at, and it's just a moment in time. Think back to when you guys might have originally had loans or whatever, you're paying 17%, people were still investing in property. So we're having this big thing about paying 5% interest only, or having to pay principal and interest at 3.88. It's not an awful problem to have, is it? So now I've got another one here saying we don't yet have a deposit apart from saving up. Are there any other options we know about? So look, there are a few options. Obviously, the deposit or the funds to complete is important. You do have options there. So there's a few questions. Have you purchased residential property before, or do you have access to the first homeowners grant? I've helped some people, and not necessarily young. So I had one guy who's in his 50s, hadn't bought property before, and all up it cost him $3,000 to buy a property. So by the time we were able to get him a highly leveraged loan and the kind of complex we needed to find, by the time he got his stamp duty incentives and his first homeowners, he only needed $3,000 or $4,000 to go ahead with the purchase. Now the tricky thing behind, not tricky, but part of getting a loan approval is, and check with the broker about this, but generally need 5% of the purchase price as genuine savings. So he was actually able to be gifted the money, sat in his account, got the approval, and then went through. But look, there are options with that. If you don't have the deposit ready, there are potential options there, even using one of your parents' properties as guarantor, or whatever it may be. So everyone's situation is different, but we do have some strategies in place to be able to help out there. So please have a chat with your mentor about that. I'm sure they'll be able to help. Okay, well that's all the questions that have come through for tonight, and thanks very much for attending. It was a nice, short, sharp presentation. If I've gone too quick, I apologise, but I have recorded the session and I'll send that out to you as well in an email, so you can go back, listen to any of the dribble I might have said. Any questions, you'll have my details, so please let me know, and enjoy the rest of your evening, and thanks very much for tuning in. So thanks guys, have a good night.